Imagine waking up tomorrow, turning on the news, and hearing that one of the world's most critical shipping lanes is suddenly closed. The Strait of Hormuz, a narrow waterway connecting the Persian Gulf to the Gulf of Oman and the Arabian Sea, is blocked. No tankers are moving, no oil is flowing out of the Gulf, and global markets are in chaos. Oil prices are skyrocketing, economies are wobbling, and governments are scrambling to respond. Sounds like a nightmare. Well, it's a nightmare that could very well become reality if tensions between Iran and the rest of the world escalate. Welcome back to Hidden Finance Truths, where we uncover the hidden forces shaping our global economy and the strategies behind geopolitical money moves. Before we dive deep into this, make sure you hit that like button and subscribe to stay updated with all our latest insights. You do not want to miss this. The Strait of Hormuz might seem small on a map, but its importance cannot be overstated. It's only about 21 miles wide at its narrowest point. Yet through it passes nearly 20% of the world's oil supply. Think about that 1/5 of all the oil consumed globally flows through this tiny waterway every single day. Countries like Saudi Arabia, the United Arab Emirates, Iraq, and Iran rely on this channel to export their oil, while major consumers like the United States, China, Japan, and Europe depend on it to power their industries, transportation, and homes. Every day, around 21 million barrels of crude oil pass through the strait. To put that in perspective, that's more than 7.6 billion barrels a year. It's the artery of global energy, and any blockage would ripple through economies worldwide almost instantly. Now imagine a scenario where Iran decides to close the strait. Why would it even consider such a drastic step? The reasons are deeply political and strategic. Iran has often threatened to close the strait in response to sanctions, military pressures, or conflicts in the region. The strait gives Iran tremendous leverage because global energy markets depend on its free passage. If Iran actually blocked the strait, even partially, it could ignite panic in global oil markets, forcing nations to rethink their energy security strategies almost overnight. The immediate effect of a closure would be felt in oil prices. Oil is traded globally, and any disruption in supply triggers rapid price movements. Historically, tensions in the strait have caused oil prices to spike by 10, 20, even 30% in a matter of days. If the strait were completely closed, analysts' project prices could more than double in some cases, sending gasoline, diesel, and heating oil costs soaring. For everyday people, that means higher prices at the pump, more expensive goods, and a ripple effect through almost every sector of the economy. Companies relying on energy-intensive production would see costs rise. Transportation would become pricier, and inflation could accelerate sharply. But the impact wouldn't stop at oil prices. A closure of the Strait of Hormuz would send shockwaves through the global economy. Countries heavily reliant on Gulf oil, particularly Asian economies like China, India, Japan, and South Korea, would face severe energy shortages. Shipping lanes would need to reroute around longer, riskier paths, increasing transport costs. Stock markets would tumble on fears of economic slowdown. Even the United States, while not as dependent on Gulf oil as some Asian nations, would feel the pressure through higher gasoline prices, inflation, and uncertainty in energy markets. Global trade, already fragile due to geopolitical tensions and supply chain disruptions, would experience further instability. Energy security would become a top priority for governments. Nations might release strategic petroleum reserves to stabilize markets, but reserves can only cushion the blow temporarily. Alternative routes, like pipelines bypassing the strait, are limited and cannot handle the full volume of oil. Military tensions could escalate as naval forces attempt to secure passage or challenge Iran's closure. The risk of miscalculation or direct conflict is high, which could worsen the economic impact and prolong the crisis. It's not just about economics. It's a strategic chess game at play. Iran's potential closure of the strait acts as both a deterrent and a bargaining chip in international negotiations. By threatening global energy security, Iran forces other countries to pay attention to its demands, whether they are about sanctions relief, diplomatic recognition, or regional influence. For investors and financial analysts, this creates a high-stakes environment where every news report, every military maneuver, and every diplomatic statement can shift markets. Hidden Finance Truths dives into these connections regularly, showing how geopolitical money strategies are often hidden in plain sight, influencing economies in ways most people never notice. Let's also consider the ripple effects on oil-importing nations. Countries like the United States, where gasoline prices are closely watched by both consumers and policymakers. A sudden spike could trigger political pressure on leaders to act quickly. European nations reliant on Gulf oil might see energy-intensive industries struggle to keep operations running efficiently. Asian manufacturing hubs could face blackouts or slowdowns if alternative energy sources aren't available. Even the shipping industry itself, which relies on predictable routes and schedules, would need to adjust dramatically, potentially increasing freight costs globally. One of the often overlooked consequences is the psychological impact on markets and consumers. Panic buying, speculation, and market volatility could worsen the crisis. Oil futures could become a hotbed of rapid trading, pushing prices even higher. Financial markets thrive on predictability, and the closure of the strait introduces a high degree of uncertainty, creating opportunities for some but risks for nearly everyone. Investors in energy stocks, ETFs, and commodities would need to monitor every development closely. Hidden Finance Truths specializes in dissecting these kinds of geopolitical financial risks, helping viewers understand how global money strategies intersect with real-world events. What happens if the closure drags on for weeks or months? Prolonged disruption could lead to a global recession. Industries would face higher operational costs. Consumers would spend more on energy and goods. And central banks might struggle to balance inflation control with economic growth. Countries might turn to alternative energy sources faster, accelerating shifts toward renewables. But these are long-term solutions and cannot immediately replace millions of barrels of oil per day. The global economy would feel the effects on every level, from transportation and manufacturing to household budgets and government policy. Even if the strait is only partially blocked, such as limited attacks on shipping vessels or temporary closures, the market would react violently. Insurance premiums for tankers would skyrocket, shipping delays would increase, and traders would hedge against uncertainty by pushing oil prices up. The mere threat of closure has historically caused measurable economic consequences, proving the delicate balance that keeps global energy flowing smoothly. It's important to understand that the Strait of Hormuz crisis isn't just about oil. It's about the interconnectedness of global economies. Energy underpins nearly every industry, every transaction, every product on store shelves. When a critical choke point like Hormuz is threatened, the ripple effects reach across continents, impacting governments, corporations, and everyday people alike. Hidden Finance Truths often explores these hidden financial linkages, showing how crises in one region can reshape markets, trade, and wealth worldwide. So, what can be done to mitigate such a crisis? Diplomacy is the first line of defense. International pressure, negotiations, and incentives to prevent closure are critical. Military preparedness serves as a deterrent, but carries its own risks. Strategic petroleum reserves offer a temporary safety net, but long-term solutions require diversification of energy sources, alternative shipping routes, and stronger energy alliances. The reality is that even with all precautions, the global economy remains vulnerable to sudden disruptions and strategic choke points, like the Strait of Hormuz. By now, you might be realizing just how fragile the global energy system can be, and why the Strait of Hormuz is often at the center of geopolitical headlines. It's a reminder that finance, economics, and geopolitics are inseparable. Every tanker, every pipeline, and every policy decision has consequences that ripple across borders, affecting millions. If you found this explanation eye-opening, don't forget to like this video and subscribe to Hidden Finance Truths for more insights into the hidden forces shaping our world. Your support helps us continue uncovering these critical stories and sharing them in ways that are easy to understand. As we wrap up, remember that the next time you fill up your tank or check oil prices, there's a complex network of political, economic, and strategic factors at play. The Strait of Hormuz may be narrow, but its influence is enormous. Understanding these connections is key to making sense of global finance, energy markets, and economic policies. If this video made you think differently about the world, leave a comment below with your thoughts on how countries should respond if Iran ever closes the strait. Share this video with friends who care about global news, economics, or energy markets so they can understand the stakes too. Hidden Finance Truths is here to make sense of the invisible forces moving our money and shaping our world. And together, we can stay informed and prepared for whatever comes next.